We've got about an hour, and this is one of two parts here that we're going to go through. This first day is going to be more on legal issues, setting up a business entity, how international startups do business here, a little bit about IP and patent, and then when I come back in a couple of weeks, we'll talk more about fundraising and some more startup basics. So let's see if, all right. I'm going to share my screen in a minute. Before I do that, if you have questions, I'm going to take some questions towards the end, or maybe even during if you want to chat them to me. Use the chat box for questions, and I'll get started. I'm going to give you all my information in the chat. That's how you can find me if you want to follow up with me later. But go ahead and chat to me if you got questions while I'm speaking. What else? I think that's it for introductory remarks. Feel free to find me on LinkedIn, send me an email if there's anything you'd like to talk about. Now, I'm going to share my screen. So let's see how well this chat box works. Can you see my screen? Somebody send me a chat. Anybody? You should see a slide that says, all right, there we go, good. Good, great. It seems to be working. You should see a page that says disclaimer now, right? Awesome. So I'm going to talk high level about startup legal. We're going to go through several different topics. I've been doing this for 35 years or so. I've counseled thousands of startups. I tell people 10,000, it could have been that many. And I've seen a lot of the legal issues. It's the same issues that come up again and again and again. And I'm not trying to make any of you lawyers here today, but what I am trying to do is give you an idea of what the issues are so you can be careful about them. You can know what questions to ask your lawyer, and you can know what mistakes to avoid. So let me start with the very first one. We don't have to spend a lot of time on this, but I do want to pause on it because it's kind of surprising how little thought often goes into this very first question that you need to answer. The very first legal decision you need to make is what sort of entity are you going to be? Now, by the way, I'm licensed in 6 or 7 different states. None of them are Delaware, but probably 99% of the companies I form are Delaware C corporations because I do tech startups. And the kind of companies I usually work with, not always, but usually work with, are companies that are going to get, they're either going to get funded or they're not going to succeed. They're going to start, they're going to get some friends and family, some angel money, some venture capital money, and then exit. They're either what I call go big or go home, right? They're either going to go that route or they're not going to succeed at all. Now, there's a different kind of company, I call it a lifestyle company, that's going to be able to get to profitability, but it's not going to have that huge scaling potential that the VCs demand. And we'll talk more about that in 2 weeks. But if your company is the kind of company you're going to get to profitability and you're going to generate a nice income and it'll keep you and your partners or your co-founders, reasonably, well compensated. That's not a venture capital play. We should think about what type of entity you should be to make sure that you get a good tax result. On the other hand, if you're like most of my clients, where you're not going to get profitable anytime soon, maybe never, before you exit, instead what you're going to do is you're just going to grow and scale really rapidly, and you have the potential of getting really big, provided that you get some venture capital money or something like that. Then you're a Delaware C Corp. The reason why is because that's what the venture capitalists want to invest in. Okay, they don't want to invest it. They can't invest in an S Corp, so we don't need to talk about that. They can't invest. They don't want to invest in a limited liability company. They want a corporation. Why is that? There's a couple of things, and this is something that everybody should be talking about. Qualified small business stock, QSBS. What this means is that an investor in the C corporation stock, and I'll tell you what the C means in a minute, but an investor in that stock, if they hold that stock for 5 years and then sell it, they can exclude gain from federal tax, not state in California anyway, but gain from federal tax up to the higher $10 million or 10 times our cost basis. That's a pretty significant incentive, especially at the angel level. And you as founders have that benefit as well. It's really significant. It's really important. And it's something that really drives a decision to be a corporation or a C corporation. As I said, VCs and tax exempts and foreign investors for that matter, that's all that they're going to invest in. And finally, our corporate tax rate is really low right now. If you've been reading the papers, you see that Joe Biden wants to increase that. Went down in 2018 to 21%. There's a proposal to push it up to 28%. I just don't think it's going to get there. I think 25 is more reasonable. That's still really low, right? That's still really low because the individual rate's at 37, probably going to go up to 39 by the time we're done. Now, sometimes you just don't know. If you're the kind of company that's going to, like I say, go big or go home, you don't know if you're going to get ventured, but if you don't, you can still survive. You can still make money. You still got a good product. It just won't scale into, a unicorn or a decacorn. And if you don't get venture, you don't want to become a C corporation because it is relatively tax disadvantageous. Why is that? Because there's two levels of tax on a corporation. One at the corporate level, and again, when the shareholders get their money out of it. So typically, other than, some of these considerations I just mentioned, you'd rather be a partnership or what we call a limited liability taxed as a partnership, or even taxed as an S corporation. It's a pass-through. It's one level of tax. And if you do the math, you'll find that you come out better that way, especially if the corporate rate goes up. So for a lot of times, what I'll do for those companies is I'll start them out as LLCs, taxed as partnerships, and then we can kind of wait and see, right? And if it turns out that you get profitable, but you don't get investor interest because you don't have that scalability, but you do have profitability, you know what? Sorry about this. I should probably, there we go. Then we should have done this from the start. Then we might want to do an LLC and just wait and just convert into a corporation down the road once we do get venture investors that make us do that. I do that all day long. I do that all the time. And if we don't get those venture investors, we've got a really good business here that we can continue to use. All right, let's move on here. So qualify small business stock, we already talked about. I'll just pause on that. It's a huge benefit, and it's something that oftentimes drives a decision. It's something you ought to be, making sure your investors know that you know about. Your next decision, once you decide what kind of company that you want to be, is going to be how are you going to capitalize that company, right? In other words, who's going to own the company? So number one, most of the companies I work with have co-founders. Not all of them, but most of them. So if you have a co-founder, your company becomes way more complicated almost immediately, because now you have to figure out equity ownership. And secondly, you have to figure out how to protect that ownership in case somebody leaves, because you're founders, your sweat equity, you're getting your ownership in exchange for all the work that you're putting into it. So think of this in terms of different classes or categories of stakeholders. One are the founders. They're going to get stock. If there's more than one founder, it's going to be what we call restricted stock. That means that it vests. I'll talk more about that in a minute. You've got your rank and file folks. And my rule of thumb is anyone under 1% ownership, I want to think about giving them an option. An option is a right to buy stock at today's fair market value, so that the optionee, they share any upside of the stock, any future appreciation. If you can buy it for $1 today, you're betting it's going to go up. The beauty about options is you don't have to pay anything. You can just have that right to buy the stock and you never exercise it. You just cash it out at the end when the company sells. So the employee participates in the upside, but doesn't take any of the downside risk of having to actually pay for it. It's a great deal. The trade-off, of course, is that the tax is at a higher rate. It's at ordinary income rates rather than lower capital gains rates when that employee does cash out. There's a couple of other things you might have heard of. Phantom units I use every once in a while, and that's just a bonus plan. We call it phantom because it's a unit, it's a contractual right that mimics stock ownership. So rather than giving someone an option or a share of stock, they'll just have a contractual right to a payment, provided they're employed by the company at the time that it sells or exits. And then they get the same cash as if they'd actually owned stock. There's lots of reasons we might do that. Sometimes to avoid securities laws, usually to avoid tax consequences, etc. RSUs, we don't have to talk a lot about. You just wouldn't do this in an illiquid startup company. And RSU is a restricted stock unit. It means that when you vest in the stock unit, when you on each vesting date, you actually have shares transferred to you. That's a taxable transaction. If you're working for a publicly traded company, it's one thing. You can turn around and sell some of those shares, pay the tax. If you're working for a illiquid startup, you don't want to have tax and no cash. We'll talk a little bit more about this later, especially the tax codes. I don't want to put you to sleep this afternoon. And then on your cap table, you're going to have the equity ownership. That's all common stock that I've been talking about so far. That's what the founders and service providers get. And then you're going to raise capital. And usually the first money in is going to come in as some sort of convertible. What do I mean by a convertible? I mean an instrument that converts into equity down the road. Convertible notes, for example, people are still using them apparently outside Silicon Valley. And then this other thing called SAFEs, simple agreement for future equity. Think of it as convertible equity. Think of it as investor gives you money today, but they get stock tomorrow or at some later date when the company goes out and prices its stock. We don't know what the company's worth today, so we can't give you stock now. We'll know what it's worth once the VC comes along and puts a price on it. Then you get your stock. So you give us the money now, you get the stock later. The trade-off, of course, is that the early investor in the SAFE, the agreement for future equity, is going to get in at a little better price than the later venture capital investor. Series C preferred stock is preferred. What we mean by preferred is that it has a preference. Usually that means a liquidation preference. So in other words, when a company gets sold, the Series C preferred, they either get their money back or they get their percentage ownership of the company. They get the greater of the two. That's preferred, convertible preferred stock. And then just preferred stock. The difference is that Series C is a special type of preferred stock that's super watered down, doesn't have very many rights and privileges at all. Just traditional preferred is typically a heavily negotiated instrument that it costs a lot of money and has lots of bells and whistles. And unfortunately, you'd think by now it should be like buying a house. You just check a bunch of boxes on a form. It's not like that. Preferred stock is a negotiated transaction. So it doesn't happen until you're well into your company's life and hit bigger valuations. Vesting restrictions, does everybody know what vesting is? Vesting is the idea that you earn into your stock ownership, right? In other words, if I'm granted stock as a founder, right, or I buy stock as a founder, and I have a 4-year vesting restriction, that means that if I leave after 1 year, I forfeit or have to sell back at cost 3/4 of my stock, and I keep 1/4. 4-year vesting, I vested into 1/4. So that's vesting keeps people engaged and keeps them involved in the company. Now, you're probably going to hear early on in your startup's life the concept of acceleration of vesting. First of all, let's talk about the vesting period. You should absolutely expect to have to vest into your shares. Absolutely. If there's more than one founder, or if you have an investor, because the investor needs a way to keep you around, and your co-founder needs to make sure that you're going to stick around. And if you don't, they can get those shares back to incentivize another co-founder to take your place. So that's the vesting concept. The period, though, is how long should that last? You're going to hear 4 years a lot. It's 3 to 5 typically for almost everybody, except for advisors, 3 to 5. So people will often compromise and say 4. Here's what you should know about that. Don't get too attached to that 4-year term, because you're going to almost certainly reset that 4 years before you're done. You should probably expect to vest for about twice that time. The reason why is because when the later investors come in, they need assurances that you're going to stick around, right? And they do that by making you unvest your vested shares and start your schedule all over again. Now they'll give you credit for time served and things like that, but still you're going to undergo some additional vesting almost always. And there was a time, the reason, and I know what you're thinking, well, why don't we just start with 8 years if it's going to take 8 years? Well, there was a time when companies got to liquidity a lot more quickly than they do now, because it was way easier to go public. 20 years ago, 4 years was plenty of time, maybe 5. That's not true anymore. It takes a long time for a company to go public, if ever, probably won't. So it might exit some other way. In addition, a typical venture capital fund life is on average going to be around 4 or 5 years. So that means they might get in at the beginning of their life and you might be there for, the VC might not want to exit, until way down the road. So what usually happens now is what I see as vesting is usually around 7 years is what people can expect. Just, unless they're lucky and they exit early or something like that. Now, I'll go ahead. Yeah, I'll take some of these questions as we go along. How big a flag is it for investors if a startup does not have a vesting mechanism for all of its co-founders? The investors, it's not that big a flag. It means you just haven't thought about it, but the investors are going to impose that when they do their investment. They absolutely will. So it's not a problem at that point unless it's a problem, unless one of your founders says, no, I'm not going to invest my shares. Why would I do that? Then it's a problem. So that's why I think you should have these vesting restrictions in place early. I guess that's the biggest problem. If you get a co-founder that doesn't agree to impose vesting restrictions. The other problem, though, that you might think about is that, and this is more psychology than law, but if you've got a vesting restriction in place when the investor comes along, and it might be 3 instead of 4 years, and it might have some double triggers in it, which we'll talk about. It might not be exactly what the investor wanted, but close enough. I call that a preemptive vesting. You've put something reasonable in place so you don't have to fight that battle again and end up in a worse place with a worse result. So I would say not a huge red flag. It's a bigger problem for the founders, because what happens if one of your co-founders leaves and has fully vested shares? That happens. You should go Google Zipcar and read the story of Zipcar up in San Francisco. Now, they did really well. They're a very successful company, despite the fact that they messed up on their vesting and stock ownership. They got that all wrong. And that's not me talking. That's one of the co-founders has spoken about that over the years, and how much easier life had been if they'd gotten this right. Most companies couldn't survive something like that. If you get this wrong, and a founder leaves with vested shares, that's a very, very difficult thing to overcome. So you need to put that in place as soon as possible. And if you have 2 co-founders, maybe if one leaves, your company's toast anyway. If you have 4 co-founders, that happens. Almost certainly someone's going to leave, and you're going to need those shares back. I wanted you to understand the term single and double trigger, because you're going to hear it. And this is the acceleration concept. Acceleration means that a co-founder would get additional vesting because something happened, like the company got sold, right? And it was a stock for stock deal, and I got stock in Microsoft in exchange for my stock in startup company. And because I did my part, I got the company to exit. Gee, I shouldn't have to vest anymore, so I should have all of my shares vested on change of control. That is a single trigger change of control acceleration. Often requested, rarely granted. Okay, 20 years ago, I could get away with it because people weren't thinking about it, but rarely these days. Similarly, another single trigger, termination of service, right? What happens if we got 3 co-founders and 2 of you gang up on me? Because that's what always happens when you have 3, it's 2 against 1. What happens in that case? Shouldn't I get accelerated vesting? It wasn't my fault. You just ganged up and kicked me out. You shouldn't be able to take my shares away. That's a single trigger termination of service acceleration. Again, often requested, rarely granted. What is often granted, though, is double trigger. Look, if you get terminated without cause within 6 months or a year of a change of control, then you can have your accelerated vesting. Okay, because at that point, yes, you did everything you should have, and it's not your fault. Your job was made redundant through the acquisition. So we'll give you that acceleration. Reserve that for only your most senior people. Okay, that's not something that goes in your stock option plan. That's just for founders because it's expensive. It's expensive because it's going to increase the cost of an acquisition because now the acquirer has to come up with, possibly additional unvested shares to replace the founder who's left. I might circle back to some of these other vesting restrictions. I got a lot I want to get through, and I'm only on slide 8. Let's talk about some of the startup legal mistakes that I see a lot because I want to maximize our time. One problem that we oftentimes see, especially here in California, we have a whole sort of different body of law around employee rights. So I say especially here in California. What I mean is that there are special laws in California that protect the employees. Now, the very first question I ask a founder when they come into my office and sit down or join me on Zoom and they're starting a company, very first question is, do you have a day job? All right. Do you have a current employer? If you do, I need to know this new company you're starting. Did you develop it on your current employer's time? That's a bad answer if the answer is yes. Did you use your employer's facilities, their computer, their lab, their office, their anything, their notepads, their pens? All right, that's a little extreme, but you get the idea. Did you use the employer's facilities? And this thing that you're doing, is it related to your employer's business? Is this the thing that they hired you to do? And did it result, this startup company, this idea or this product or this tech, did it result from work performed for the employer? The answer's got to be no to all those questions. Otherwise, your employer might own your company, or they might own your idea, or they might have rights to that business or to that technology. So this is what I call a dead on arrival issue. By the way, I do have a book. I don't know if you can see it. It's called Dead on Arrival, How to Avoid Illegal Mistakes That Could Kill Your Startup. If any of you want to email me after this, I'll send you a digital copy of this book. It's a short read. It's not very long, pretty thin, because I like giving people a sense of accomplishment. So you'll be able to finish this easily. But this is a dead on arrival issue. If your employer owns what you have, just forget about it. Go back to the drawing board. So we got to answer those questions and make sure we answer them correctly. Don't make that mistake. Second thing I want to mention is documentation. So many companies do business on a handshake, and it's surprising how little paper it takes to establish legal rights, but it's surprising what a problem you have if you've got no paper, right? So if you've got a document that says Joe owns 25%, it's pretty hard for Joe to come along and claim he owns 50. If you've got nothing with Joe, he can claim whatever he wants. So it's really important to have documents that establish equity ownership. I prefer you have a lawyer write those up, but even a cocktail napkin will suffice. When I first started practicing law, I used to litigate, and I actually sued somebody based on a piece of paper that was in handwriting that was this size, right? It was just a little bigger than a cocktail napkin, and we won that lawsuit. And her argument was, well, that lacks all sort of formalities. It doesn't really look like a legal document. Doesn't matter, right? So it's really important to have stuff on paper, but I'd rather you have a formal legal document. Here's a sleeper for you. You've got co-founders. Usually there's a money partner and a service partner. Guess around here it's all service partners, but suppose you have somebody putting money into your company. You really want to document what it is they're doing, right? Are they loaning money to the company, in which case they get it back when you get funded? Are they contributing it for their stock, in which case they don't, right? That's their contribution. Their contribution is cash. Yours might be services. Or are they expecting some sort of preference? You really need to document that, because if you don't, the default is a big mess, right? It's just, what did the parties agree? What is the agreement? You're going to go, and that's a lawsuit, and no investor wants to fund a lawsuit. So don't do it. Don't do it. And investing, as we discussed, that clearly has to be in writing. And there are tax and corporate filings that have to be made as well, by the way. I want to mention that. We talked already about vesting. Let me drill down a little bit more on that. Big mistake I see companies make is they don't file this form. It's called an 83B election with the Internal Revenue Service. If you don't file that form, you're basically the founder or the stockholder is going to have taxable income. They're going to have income they got to pick up on their tax return every time there's a vesting event if that stock is appreciating, because it's as if they're earning the stock for services as it vests, because that's what vesting is. You're earning into the stock. The 83B election allows you to avoid that. By the way, I want to pause on one thing here, and this is a little bit mixed lore and law, but advisors, you heard me say 3 to 5 year vesting. There's a class of people that's going to have a whole different vesting schedule, and that's advisors. They're usually going to vest over 2 years because an advisor's role is relatively short term. They're going to help you find money. They're going to help you with your first 6 customers. They're going to help you with domain expertise, whatever it is, some technical problem, whatever it is. But it's a relatively short term, so we don't put them on this long vesting schedule. But more importantly, the mistake people make is advisors are not punching a clock. They're not coming in to work. They're not getting on Zoom calls with you every day. You might see them every other week if you're lucky. So you need a metric and a milestone, right? You need a performance metric. You vest when you bring me those 6 introductions, or you vest when whatever you hit the, you bring me this sale, etc., or something like that. So that's advisor vesting. These days, we definitely want performance metrics and milestones. Somebody asked if we can open or register a company while working for a current employer. Yes, but remember my 4 things, right? It can't be this thing that you've done, can't be employer time, can't be employer facilities. It can't result from work performed for the employer, and it can't be the thing the employer hired you to do. If you do it on nights and weekends, it's all yours. California guarantees you that right. By the way, you cannot contract that right away either. Even if your agreement says nothing about it, you still have that right. So, but you got to comply with these rules. And oftentimes people don't. And nobody cares until they're successful. And then you get that letter from a prior employer saying, thanks very much, that's ours. Tax preparation, I think we already talked about this. I don't want to drill down too much more on tax. Labor laws, I really do want to mention because this is on everybody's mind. Like I say, I've counseled or I've met 10,000 startups, and I don't think I've ever met one that can guarantee me that they've complied with California's Byzantine employment laws. Even large companies get this wrong. Large companies with big, sophisticated in-house HR departments get this wrong. Even my law firm has gotten this wrong back when I had a law firm, because it's just almost impossible, right? Meal breaks, lunch breaks, overtime, bring your own device policies. It's almost impossible. So the good news is that nobody expects you to comply with this law. Think about this for a minute. California's employment laws are so tough, the investors don't even expect you to comply. The market just factors into their valuation decisions that there are labor laws, and you do the best you can. However, there are some rules that the market does expect you to comply with and will punish you if you don't. And the biggest one is misclassification, right? Misclassifying people. Treating people who should be classified as employees as independent contractors. Take a look, Google a company called HomeJoy. They raised $40 million in venture capital. They were sued in a class action lawsuit for misclassification, and that was it. They're done, right? No more money, no Series B round. And the CEO later said it was because of that lawsuit that he couldn't raise any more money. And they had a really great idea. It was a gig economy. It was a platform for housekeepers, Uber for housekeepers, basically. So we have to pay attention to labor laws. And that brings me to AB5. Here in California, we have a rule. I think Massachusetts has a similar law. There might be one other state considering it, that the platform workers, it started out being rideshare drivers were automatically employees and not contractors. You all know, if you've been reading the papers or if you've been in California, that was reversed under a referendum. So rideshare drivers are carved out of the rideshare driver law, but everybody else is included. Well, that wasn't very fair. So we got AB 2257, which carved out 60 categories, depending on how you count, 100 different exceptions to this law, but some people are still caught. And these are gig economy workers. So to cut to the chase, it means here in California, if we have an ABC test for determining who's a contractor and who's an employee. So if you're here in California and you're a gig economy worker and the thing that you're doing is in the trade or business of the company that you're working for, you're automatically going to be deemed to be an employee of that company. So for example, let's go back to my HomeJoy, right? Platform for housekeepers. So I go on HomeJoy, and there's a time I could have done this, and I say, gee, I need to have my house clean, and I find somebody, and I send them a message, and they come clean the house, and they pay, and I pay HomeJoy, and HomeJoy pays them. Under this law, that person would automatically be an employee of HomeJoy. They would not be an independent contractor. What does that mean? That means tax withholding. That means benefits. That means wage and hour requirements. That means meal breaks. That means rest breaks. That means double overtime pay. It means a whole bunch of stuff. It means they're entitled to the benefit of all our employment laws, including anti-discrimination, disability laws, on and on and on. And here's the big one, because this is the thing that caused some of my clients to call me up and say, never mind, we're done. As soon as AB 5 became law, workers' compensation. If you mess up on this other stuff, that's bad. That's real bad. That's going to cost you a lot of money. If you mess up on workers' comp, there's potential criminal liability. So, and that's just not something that anybody, any of you can really take a risk on. It's rare that it's applied, but it's still there, and that would bother me. So labor laws is an important one. You got to get that right. Don't misclassify. Intellectual property. Another really big issue I want you to think about. First of all, if you're a tech company, you have to own your technology. Your investors are going to insist on that. Your acquirers are going to insist on that. Kind of makes sense, right? If I'm a trucking company, I better have rights to use my trucks, right? If I'm a real estate company, I better own my real estate. If you're a tech company, you better own your tech. In law, ownership has kind of a subtle difference than what you might think. The law says that I own this iPhone, not because I have a right to use the iPhone. I own the iPhone because I have a right to keep you from using it. That's what ownership is. I can keep other people from using it. That's what ownership is in technology and intellectual property. Well, how do we establish that? Well, first of all, there's a lot of different ways. But when it comes to trade secret, which is most of my clients' most valuable intellectual property asset, just those valuable secrets they have that nobody else has, it's usually contract. And the first contract you need is a proprietary invention agreement and invention assignment. Also known as proprietary information agreement and invention assignment, also known as a confidential information agreement and invention assignment. And this is an agreement that all of your employees, consultants, advisors will sign. Anyone who touches your IP, your technology, will sign and say, everything I develop for the company belongs to you, the company. Now, if they don't sign that, they might have a non-exclusive license to use the technology that they developed for you. Why is that bad? Go back to my definition of ownership. You can't say you own it if you can't keep them from using it. A non-exclusive license means that they can use it. So you need to get those things signed up. That's kind of the one biggest thing, because I know business people, they say, well, this is just paper. Why do I have to deal with this stuff? Well, this stuff is really important. We'll talk more about IP in a minute. I just want to, I want to jump on kind of the major issues first, and I'll drill down later. But number one, just make sure that you get good invention assignments. The company has to own its stuff. And even very well-advised, sophisticated companies will miss this, and they'll do it one of two ways. One is through inadvertence. We just forget, everybody does, and it didn't get signed. And I've had so many companies where, geez, we just forgot to have that sign. Can we do it now? Well, maybe, maybe not, because now the founders are fighting. Who knows? The other reason is sometimes if I'm representing the inventor who founded the company and not the company itself, it's rare, but it has happened. I might not want the company to own its IP. I might want it to have a license to a very narrow field of use. So if that field of use fails, you don't drag my whole patent down with you. I can use that patent for a different business. I've done that many times. Trademarks. So for most of my clients, trade secret is their most valuable asset. And we'll talk more about trade secret later, but their second most valuable asset is going to be trademark. And by trademark, I mean logo, I mean brand, I mean everything that makes up your goodwill. And goodwill is the superior earnings power or the expectation that people are actually going to use your product. Very, very valuable asset. Now, just imagine, let's use an extreme example. Let's suppose you're Snapchat early on, and you've built up 1 billion users that are worth, I don't know, or not 1 billion. You've built up 100 million users, or let's say you've built up 1 million users, but they're worth $1,000 a user in terms of valuation. That's not so far-fetched, by the way. What would happen if you had to change your name and you couldn't use that name anymore or that logo? What would happen to your users? They would be confused. They would think you're a different company. They would stop using your product. They'd go use one of the, the substitutes that has popped up or the alternatives. So how do we make sure that that doesn't happen, that you can use your name and your logo? Trademark. Now, trademark could be your most valuable asset if you're the kind of company, especially if you're a B2C that really relies on knowledge and brand awareness. So how do we make sure that doesn't happen? And I've seen that happen, by the way, where somebody will put years and years and millions of dollars, and all of a sudden, boom, a cease and desist letter pops up, and it turns out that they have no right to use their name, and their goodwill just dissipates. It's pretty tragic because it's so avoidable. Number one, do a Google search. And don't fight it. If you're early on and if you see someone's using the name that you want, don't do what some of my clients have done and say, yeah, but I really want that name, so I'm just going to use it anyway and I'll fight with them later. Don't do that. Don't do that. You're early enough. Start with something no one else is using, especially in your business. Then number two, we do what we call a patent and trademark knockout search. You search the trademark office to see if you can find your name or logo. And then thirdly, you actually do file a registration. So trademarks is just a super important issue. Don't overlook this. We'll come back to tax stuff. Securities laws I want to pause on. So the thing is that these days, and I'm giving you the big stuff first, and we'll drill down later, but these days it is super easy for you to go out and be your own securities lawyer. You can go online, you can download documents, you can send them to your investors and on DocuSign, and you can have them send money to you, and you can do all this stuff with not even knowing just how many laws you've broken and how much trouble you're in. So I suggest you not do that. I suggest you not break the law, that you consult a securities lawyer before you sell securities. By the way, not every lawyer will tell you to do that. I've heard some lawyers say, yeah, what's the problem? Go download a safe. So the biggest problem, remember what a safe is, a simple agreement for future equity. It's like a convertible note. You give me the money today, I give you the stock tomorrow. You can download those documents all over the place. I suggest that you not do that. Here's why. Number one, you can't sell stock to anybody that you want to. You can't sell to anyone you want. You've heard of buyer beware. In securities, the rule is seller beware, right? Those people have to, that sale of securities either has to be registered, like an IPO, you're not doing that, or exempt. Is that an exempt offering? Maybe, maybe not, okay? If it's not, you got a big problem, because then the person that bought it can turn around and sue you for rescission. And that's the best scenario. It could get a lot worse than that. The nightmare scenario is when it tanks your later financing, because you get into due diligence and the sophisticated investors come in and say, whoa, you've got securities law violations here. We're going to go on to the next company that's doing what you're doing. or is an alternative to what you're doing that doesn't have securities law problems, because we don't want to get sued. We don't want you to take all of our investor money and give it to someone like me to defend you. If you don't think that happens, I could introduce you to lots of folks that will tell you that does happen all the time. So just don't go there. Don't sell securities without legal advice. So I told you I was going to tell you three things. Number one, it has to be an exempt offering. Usually that means to an accredited investor. If you don't know what accredited means, then you definitely need to talk to a lawyer about your securities offering. Number two, there are federal securities law filing requirements, right? There's federal requirements. Yes, and I know there's ways around that. There's exceptions, there's common law exceptions, but keep in mind there are federal securities laws you need to pay attention to. And number three, and I'm surprised that people, especially the crowdfunders, constantly get this wrong. There are state blue sky requirements. What is it? Blue sky means securities laws. Every state has the right to impose its own reasonable requirements, usually a notice filing. Not every state does. Some of them do. Some of them impose a pretty big filing fee. Some of them grant a rescission right if you don't do it in time. Washington comes to mind. So it's stuff you need to pay attention to. That's one. Number two, the number two problem about going online and downloading your own documents is you don't know what's in those documents. And I have to have this conversation over and over and over again when somebody says, we're going to convert these safes that I downloaded online from a very famous accelerator. And this is what I think I sold. And we do the pro forma cap tables. It's like, I don't know what you think you sold, but here's what you really sold. Why is that a problem? Because if you give away too much of your company too early, there's nothing left for the investors, or there's nothing left for the founders, rather. And I have had deals, and it happens more and more these days because it's so easy to use these convertible instruments. But I've had deals where the investors, they come in, they look at the cap table and they say, never mind, you've given too much of this company away too soon. There's not enough left in this for you, because we know what's going to happen. You're going to take our money, for our preferred stock. And then when it comes to an exit, you're going to turn around and say, we're not working here anymore unless you give us a big carve out of equity. And we're not going to be in that position. Every investor's been stuck like that before. So you got to be super careful with this stuff. And it's not just the securities laws, but it's also doing the pro forma and understanding how much of your company you've actually given up. Let's talk a little bit about international startups. I understand this is an international group. We got about 10 minutes left. When you do business here in the United States, if you're a non-US company, and that's about half of my clients, by the way, coming into this valley, you will almost always, not 100% of the time, but almost always form a US subsidiary, not a US branch. What's the difference? A US subsidiary means that there's a foreign company that's already doing business in some foreign country that now wants to do business in the US, or it wants to attract capital, or it wants to attract markets, or it wants to attract talent. It forms a US company, and it owns 100% of that company. The reason why is because we stop tax liabilities at the border, at the US border. So the foreign company is not subject to US tax. It's also not subject to US liabilities, right? Like our employment laws that I was just telling you about. All right, that stops at, stops at the border, stops at that US subsidiary. It's a shield, it's a liability shield. It's not automatic, but we start with the US subsidiary. By the way, I'm working on this case now that stopping the US tax, that doesn't work in California unless you make a certain type of election. Don't forget to do that. Get a CPA before you do this. Where to incorporate? We talked about this. Can you guess which of these three states I'm not licensed in? I'll give you a hint. It's a state where I do most of my business. Delaware, that's right. The other two I am. We talked about choice of entity. Now let's suppose that you've put this company together the way that I suggested. We've got a U.S. company here in the U.S. We've got a foreign company in the foreign country. But now you've had a venture capitalist come along and they say, hey, we want to invest in your company. But you know what? We only invest in Delaware C corporations. You're going to hear that a lot. And you're a foreign company that owns a U.S. subsidiary. That's wrong. It's backwards. What are you going to do? You're going to do a flip. You're going to put the U.S. company on top, the foreign company on bottom, And the shareholders of this foreign company now become shareholders of the US company, which owns 100% of the foreign company, and you'll do the investment into Topco, the US company now. Very common transaction, super easy as a US matter, oftentimes complex and expensive tax-wise as a foreign matter. So you need to plan into that and be careful and know what you're doing. But that is the inbound flip transaction. We do it all the time. There is a path, there is a way. I suggest you do that sooner rather than later. I know what you're asking, well, why didn't we just start it that way with the US company on top? Good question. The reason you didn't is because you didn't know you were going to attract US investors. By the way, we're having a record year. 2020 was a record year for venture, and Q1 of this year was just huge. It was a record year for venture capital again. So this is a great time to be raising money in the US capital markets, right? And they're going to want you to flip if you haven't done it already. The longer you wait, usually the more expensive it is as a tax matter, so do it early. But you wouldn't do it if you're just not sure and you think your investors might be foreign. All righty, let me keep going here. You know, I do want to get, so we have a couple of questions. Could someone with a work visa start a company? Yes, absolutely. We do that all the time. You just can't be employed by that company. But a lot of companies in Silicon Valley are started by people who don't have the right work permits. If someone works as an employee, what should focus on negotiating while joining the startup as a co-founder? Well, two things. As the employee, you need to make representations to that company that you're not going to be bringing any of your current employer's IP over to the new company. You're just going to get the new company sued if you do that. So be very careful about that. The other thing you should probably think about negotiating is just that clear division, right? So that you don't have either of these two companies that you're now working with trying to claim any rights of the other. You probably, and a lot of companies will want you to get their consent before you take on any sort of role. I'm working on an acquisition now where we had somebody worked for a large company, then co-founded, started a small company. You know, we have really good documents at the front end that said what would happen when we ended up, you know, with a small company competing with our employer, which is what you don't want to do. And we ended up exiting, and it all worked out the way it should. If there'd been no agreements in place, it might have been pretty ugly. Have you seen an international subsidiary with JV structure for tax optimization purpose by chance? An international subsidiary, I'm not sure I understand what that means, but I've done tons of JVs. And of course, tax is always paramount in those structures. I mean, you always want to minimize tax consequences. And with JVs, there's a lot of ways that you can do that right and minimize the US tax. There's a lot of traps where you can get that wrong. For example, whenever a US company transfers US intangible property outside the United States, it subjects itself to a whole different sort of international tax regime. There's something called the super royalty provisions. This now can apply in a partnership scenario if you're not careful, or you trigger a deemed gain. We might trigger, and we have anti-inversion rules. Just suffice it to say, yeah, there's a lot there. There's a lot of ways that can be messed up, but there's also a path to do that in a tax-free way. I've done that 100 times. When's the right time to set up a company? I think as soon as possible, because you want to have why do you want a company? Let's step back. Why should you have a company at all? Number one, to limit liability. If things go wrong, you want liabilities of the business to stop at the company level. You don't want the creditors suing you, the founders, personally. Number two, you need a vehicle to divide up the equity among you and your co-founders. That's corporate stock. You have a corporation to have stock. And well, I'll give you three. I always give three. Number three is you want a vehicle to gather intellectual property, because your company is creating intellectual property and technology and intangible properties that's going along. It's doing that through agreements. Well, you need a company to gather all that. I guess you, the founders, could all jointly own all this IP that you're creating. That's messy. It's complicated. It's not going to be very good when you do incorporate and you don't get all the assignments from everybody because someone's moved on. So yeah, you need it for those 3 reasons as soon as possible. All right, what if the intellectual property was created overseas? Yeah, that's the better scenario because you can bring IP inbound tax-free. You can almost never move it outbound tax-free. Is there an optimal time to set up international subsidiaries? You know, as a general rule, sooner is always better. But before here's my rule on that. You can have one person contractor in a foreign country running around doing sales. They're a contractor, they're one person. You have an employee in a foreign country, or then I think you should have a sub, at least in one foreign country to keep it out of the US. So if they're in Europe, I like to form a European-based company, pick a country, and that at least, so your German company, for example, is going to soak up all the liabilities from all of Europe, because your German company might employ people in France, right? But if something goes wrong, and you know how hard it is to fire people in Europe, the US company doesn't get drug into jurisdiction. It's just the German company that does. So I like to that's about when I set it up, is when you get an employee. Not before, because it's too expensive and you don't need it and you don't know how you're going to do, but I would rather do a company rather than a branch, let me put it that way. Holy cow. Okay, are there rules governing the tokens you issue on your platform for game? Yes, there are lots of rules. In fact, I have hours and hours and hours about tokenization and the laws around tokenizations. Of course, NFTs are the big thing right now, which are a real legal quagmire. We just don't have time to get into it now, but yes, absolutely. I will leave you with this. Those tokens are going to be one of 3 things. They're either going to be a currency, welcome to FinCEN regulation. They're going to be a security, that's most likely, that's usually what we have, welcome to SEC regulation, or they're going to be a commodity, that's CFTC, Commodities Futures Trading Administration. So CFTC Commission, Commodities Futures Trading Commission. So you're going to be regulated is the answer if you issue tokens by somebody, and it's usually the SEC. And the SEC, especially now under our new SEC chairman, is not taking a light hand at all to this. They're forcing a lot of these companies offshore. I'm not saying there's not a path. There is. I've done it 100 times. But just keep in mind there are laws.